Good morning and welcome back to the Share Series and our first ever hybrid event live at the NYSE. Before we get started, I just want to remind everybody of the video option to ask questions on the top of the player. Submit that to submit questions directly to us as we go throughout. This morning, I have the pleasure of interviewing Andras Bende, who's the CFO for International Money Express. I'm going to turn it over to him for some opening comments, and then we'll jump straight into the questions. Andras?
Yeah, hi. Happy to engage with you all today. I've been just a quick background on me. I've been the CFO for International Money Express since late in 2020. Company started in 1994 in the remittance services space. Happy to tell you more about the company. I'll pass it back to Dan for specific questions, and hopefully we can get you what you want to know.
Yeah, so when you think about, and I'm going to call International Money Express Intermex, because I think that's commonly what people refer to as. And so when you think about Intermex, you guys have a lot of brand recognition, in Mexico, Central America, but not really in the US. Can you talk a little bit about, what Intermex does, what your competitive set is, and what your general consumer looks like?
Sure. Let's start with the consumer. The consumer for us, somebody typically from Latin America who's come to the US to live as lean as possible and really earn and send as much money possible back to loved ones back home. They're sending money back to home for rent, for groceries, for medicine. So really the critical is to support the family, taking advantage of the economic opportunity that a robust economy within the US offers. We are a leader to Latin America in terms of remittances. We have the ability to send digital, which means from a handheld device, but really the company grew from the retail space. So we have networks of thousands of small Latin American owned businesses, which is, where we think it makes the most sense for us to be, that we partner with. So, and they're typically, other businesses that will, often they're in the food service industry. So something like a bodega or a Latin American grocery store, or a taqueria even, may make sense, and we'll partner, and that agent will have, a terminal. And when this is typically a place that our consumers frequent for other reasons, and they will come in with some regularity, and the agent will use their technology to actually collect, let's say $400 they want to send their family in Mexico. Our technology will go and take care of all the compliance screening, and then link up with the partner network within Latin America, where that consumer would like the payout to happen. So that's as simple as it is in terms of what we deliver. And we do offer a differentiated value proposition for the individual who's sending, and also for the retailer, but we can get into that in a moment.
Okay, perfect. So let's talk a little bit about the market. I think you guys are in 4 countries right now. Can you talk a little bit about the total addressable market and where you are today and what the opportunity is?
Yeah, we're actually in every Latin American market, but the top 4, Mexico, Guatemala, El Salvador, and Honduras, those 4 constitute 76% of all U.S. remittances to Latin America. And we're north of a 21% share in those markets. So that's really where our wheelhouse is, though we have the ability to send to really all of the markets in Latin America, and most of the Spanish-speaking markets in the Caribbean as well. The company, so for us, that means $100 billion plus market. And that market, if you look the past, 5-7 years, is growing about 10% per annum. And Intermex is growing much quicker. Intermex, with the differentiated value proposition, which I can talk about, is allowing us to grow a lot by share. So last year, our growth was around 19% on the top line, around 20% on that from an EBITDA perspective. If you go back into 21, you're talking almost 30 on the top line. It was 29% on the top line, with EBITDA growth around 27. So pretty solid growth. And the way we're able to do that at Intermex is by taking share.
And so let's talk a little bit about that. And so you've got kind of 2 dynamics. And so the overall industry is growing. You guys are also taking share. And so can you speak specifically, to what the differentiators are and why people would you choose Intermex over a competitor?
Sure. A lot of it goes down to beliefs. And one of the core beliefs that we have is, folks are sending for as I said, groceries for rent, for medicine, it's not a commodity. And if you can differentiate your service, you can charge a premium. And so Intermex is typically the most expensive provider almost without fail in all of the retailers. And the reason that is a couple of things. So let's talk about first the proposition for the agent partner. When we talk to potential agent partners, we want to go where wires are already being sent, where there is competition already, and we'll sit and we'll ask them what their pain points are in their other providers. And inevitably, speed and ease of use of technology is something that we hear. Banking relationships, because ultimately those agents need an easy way to settle with us. And so we hear that as a pain point for them. And also customer service. And, it sounds kind of glib term, customer service. What could that mean if somebody is taking money over the counter, entering data into a terminal and then off it goes. But inevitably, that agent could have issues with their technology at some point in time, and they could have challenges for many reasons. A wire could get, a money transfer could get hung up for some reason. Maybe the name was misspelled of the individual on the receiving end. And so when that happens, Intermex, because we've invested heavily over time in technology, but also, a very capable support network. We have key performance indicators. We're on the phone in 5 seconds or less to resolve issues. And for an agent who's trying to also run a business and run a store, that's a really big deal. So from an agent standpoint, that ability to get us, ability to connect and help with issues with their technology or if a wire ever get hung up, that's a really big deal. And also through the consumers, what's a big benefit for us is we spend very, very little in marketing. This community in terms of trust and word of mouth is very, very strong. And so that knowledge that when folks send with Intermex, they may be paying a bit more, but that wire is going to get there. And if for whatever reason it doesn't, it's getting resolved quickly and efficiently. That's a really big deal. And so those are the differentiators for us and we have things like a loyalty program, a loyalty card for the consumers as well. That helps too. But the underlying brand and the trust in the brand and the ease of dealing business with us on the agent side, those are the reasons that we get selected, and those are the reasons that we're able to take share.
Okay. So speaking of taking share, let's talk about some of your competitors. Obviously, a top of mind for me is Western Union, and we've got a lot of generalists on the call. And so can you talk a little bit about who those competitors are, who are the biggest ones, and, is it more mom and pops that you're fighting against, within country?
Yeah, no, I think in terms of the competitive landscape, Western Union always comes first of mind to folks. But one of the again, different core belief for us is Western Union is very present in the large retailers. So your Walmarts, Walgreens, Ralph's, those are the types of retailers that they'd like to be in. A very different strategy for Intermex. We want to be in the smaller retailers, the mom and pop shops, where our consumers are frequenting and doing business regularly anyway. Might be somewhere where they get picked up and dropped off on the way to work. But we want to be in the communities where our consumers work and live. It doesn't mean that they never send a wire in a big box retailer, but I think there's a bit of a secular move from these large retailers to these smaller offerings. So that's a difference for us. So we don't see the yellow and black of Western Union often. We may see in the smaller, they have a brand called Vigo, and their strategy is to be very much a discounter in small retail. So we will see them in small retail, but I wouldn't call us competing as much as head to head. We're competing from the value added, and we're kind of the more expensive side of the chain. What we'll also see is we'll occasionally see MoneyGram. We'll see RIA, which is a brand of Euronet, and then about 20 different smaller providers. So names like Seagate, Maxi Transfer, Via Americas, a whole host of about 20 other providers that we'll see nationally. And, in terms of we will see in different regions, different competitors, but I would also stress in terms of, how we're growing and taking share. In the east of the US is where the company grew up. We're a licensed money transmitter in all 50 states, but you were much more penetrated with more share in the east than the west, and it's just the way the company has grown over time. And if we match their penetration in the west of the US that we have in the east, we more than double the size of the company purely organically. And that's pretty exciting for us.
Yeah, very interesting. And so let's talk about distribution a little bit. You talked about obviously the KPIs, how you monitor, and the importance of the retail piece of it. But how do you identify a new retailer to add, right? And then what does this look like? And what's the market for that? Are there thousands, tens of thousands still out there? Is it underpenetrated? Is it saturated? Give us a sense of where that is.
Yeah, tens of thousands out there. There's no shortage of space to grow. And how we identify the retailers, we'll take a very metrically driven approach. We'll use marketing data and triangulate with data from consulates and embassies to know the zip codes in the US where there are a high number of foreign-borns from the countries which we regularly serve. And so once we have that and see where are the target zip codes we want to be, we will actually get feet on the ground and go and see where the wires are being sent, because we know folks are working there and they're sending money back home, and that we'll don't seek to be exclusive. Sometimes we end up being exclusive, but we want to go where there's a retailer who is already sending wires, kind of knows how the business works, who has a high volume. And we'll talk with the retailer about those, ask what the pain points are. Inevitably, many of them play right to Intermex. And then, we'll negotiate with the retailer and say, okay, if we entered a relationship with you, first of all, you talk about things like commissions, and we want to make sure we negotiate a fair commission with the retailer. But we're not the highest commission provider either. I mean, we want retail partners that want to value the entire relationship with Intermex. And if we go and find a retailer that has great volume, they're sending a lot of wires, but they really want to squeeze every dollar out of commission with us, that's usually not a good partner for us, because we want a partner who's going to appreciate the banking relations, appreciate the customer service, appreciate how well and simple how simple our technology is to operate, how well it operates. So when we find a partner like that, we'll engage in a relationship, and typically by year 3, our target is to be more than 60% of the wires in the store. So, we target to be the premier provider there. We never want to be the only provider. It happens. Sometimes retailers sign on with Intermex and they're so happy with the service, they don't really want to deal with anyone else. They drop other providers. That's okay. We're not going to discourage that, but we certainly don't seek it out.
Perfect. And so let's talk a little bit about the transaction itself. Right. And so a lot of the transactions obviously occur in store, but you guys also have an online offering. I would assume most people aren't aware of how that works. So can you explain a little bit about how online differs from in store and kind of what the percentage breakout is between the two?
Sure. I think for us, we have an online offering and a mobile app that we feel is best in class. And it's rated 4.7 on the App Store, so it's rated pretty well, up from what it was a couple of years ago. But simple, you have the same ability what you could do in a store, have the ability to generate the wire online as well. Of course, the consumer who generates a wire online has to be banked or has to have a banking relationship already, which is sometimes a key differentiator. I think that the economics of sending in of transactions in detail, typical transaction in Mexico and retail is north of $5 in margin per transaction for the company. Online, you've got some price discovery, but it's probably about 2 to 3 a transaction. For us, there's not a real economic motivator to transition our retail customers to online, nor do we want to create channel conflict with our agent partners. But the offering online, we haven't given the specific number, but the share of our revenue from online transactions is still pretty low. It's still in the single digits. It's growing significantly year over year, but the key difference between the two is the cost to acquire a customer. Like at retail, once you've set up the relationship, which is just costing you a couple $1,000s, including equipment, those typically pay themselves back very quickly. When you talk about an online relationship, if you take the traditional routes of some all digital players and just blast marketing into the into the metaverse, it can be a pretty expensive way to go and capture customers. So if it costs you between $75 and $100 to pull a customer through traditional marketing in the metaverse, and they transact it at $2 to $3 margins, for 10 times a year, the payback is not entirely proven, and different corridors behave different ways. I'm speaking of the US to Latin America. There are other corridors that are much more digitally penetrated. They're going to have a much more banked customer base. So those may behave differently, but the US to Latin America corridor is still very much heavy on retail. So what we're going to do is we're going to be omni-channel. We're going to offer what we feel is the best option and service in both, and we'll let the customers choose.
Makes complete sense. And so way into the cost structure. And so let's talk a little bit about that. Obviously, you guys have really nice EBITDA margins. How you control costs, what you've done there, and is there more room to run?
Yeah, I think in terms of, we feel that EBITDA margins between 17 and 20% are healthy for a company our size and growing our rate. We use that as a bit of a guide. We don't obsess about those in terms of guiding the company. If there are investments that we need to make that are going to work their way into EBITDA, we're happy to do that. Well, if we obsess about anything in the company, it's the unit economics of the transaction. We're not going to engage in retail relationships where we are not generating margin. We're not going to engage in pricing, where we're not generating margin. So those are a couple things that maybe are a bit different. We'll see places in the country where the competition is so fierce that there's some pricing that's illogical. And we're not going to do it. We'll find different ways to operate in those geographies. But I'd say if 17 to 20% from a company EBITDA margin perspective are kind of good goalposts for us. Doesn't mean we'll go outside that, but I will say from a unit economics of transaction, that's where we will, I guess, obsess as a company. And that's part of the reason why on the digital side, we will find creative ways and much more cost-effective ways to bring on digital consumers versus, some of what's going on with some of the all digital players in terms of, large amounts of capital being spent to drive customer acquisition.
So we've got a question from the audience that's coming in, and I think you talked about this a little bit with obviously the growth numbers that you had, from a top line perspective, and your end consumer is very different, right, from the grand majority of other consumer companies. But the question was really, is there any impact to your consumers with rising interest rates, right? Consumer confidence, have you seen any of that?
Yeah, I think with in the rise of maybe where I've seen some impact, I think, is on the inflation standpoint. Our consumers are a little bit different, right? They're not. First of all, they sit in an advantageous group in terms of the strata of consumer we're talking about. There is a real shortage of labor in that group. So when wage increases went, what started to go up, they really went outsized with this group. And what we saw is those consumers, sending more often and sending most what we saw is sending larger amounts, right? And they were relatively unimpacted by rising energy costs, because many of them are not driving a gas guzzling SUV, many are not driving at all, and not affected by the consumer goods. Just the nature of them being here to the U.S. to work, they're not, buying basketball goals. But, what we've seen is that large increase in the amount sent, we've seen that start to plateau. It's still growing, but we've seen it just start to plateau. And I think that's because eventually cost of housing and food kind of works its way into the equation. Because remember, I said this is somebody who's living very, very lean and send as much home as possible. So I think that's what we've seen start to come into play. Rise in interest rates really doesn't do for the company, makes our credit facility a little bit more expensive, but certainly that's not something that the consumer is going to feel. But, the one that we've monitored the most over time is just inflation and what's that doing to that principal amount. But it's still holding up okay. It's not receding. The larger the amounts, kind of the better for the company. We make more spread on the FX that we generate and the foreign exchange that we source. But, I would say it's less interest rates and more inflation.
Okay. So another question from the audience. So it looks like there's obviously a lot of runway in North America, but are there any future plans for international expansion, into Europe? Are there any regulatory issues that would preclude you from doing that?
Yeah, no, great question. I think the philosophy of the company is we're if you serve everywhere, you don't serve anywhere well. So we're going to be very kind of cautious and measured on our growth. But what I will say is we closed on an acquisition, two pieces. We closed the U.S. piece in November, and we closed the international piece last week, actually called La Nacional. La Nacional in the U.S. as a brand is a market leader and the most recognized brand from the U.S. to the Dominican Republic. So that was a great addition for us. We're already in the Dominican Republic, but only had about a 5% share. La Nacional brings us up north of 20% share. But what was exciting about what closed last week is they have a relatively small money service business licensed in Spain, and they operate out of Spain, Italy, and Germany, but really at quite a small scale. We're talking annually between 15 and 20 million in revenue. What's exciting about that business is not only its new geography, but that business doesn't even have a digital presence. They don't even have a digital product. You've got a passportable license in the EU. So by simply turning on a digital product, you can be active in all the countries in the EU. So that's pretty exciting. But the other thing is, it's a business that was well run, but kind of capital constrained. We're, as a public company, with our the cash that we generate, we are in a really good position to support the growth in that company. There's no reason that company can't be 10 times its size or more. So I think we're going to be very measured in terms of how we approach that, how we grow that, so we can still maintain the brand and the customer service associated with that brand. But Europe is a really neat opportunity for us, and one that we're excited to get going with. We just closed on the deal last week.
So you obviously mentioned cash. You guys have done a great job, right, converting it into free cash flow. So talk a little bit about how you do that, and then more importantly, what do you do with the cash? Right, you guys have had a pretty successful buyback program. How do you think about that? Would you consider anything around a dividend?
Yeah, no, I think something that's great about the company is very capex light. It generates a great deal of cash. And then, last year you saw we spent about 12 million on capex, which was a little bit more than usual for us. This year we'll spend a little bit more just because we're doing an office move, so we're investing some capex there. But in general, for last year, $105 million plus EBITDA business, 12 million capex, quite light. So we do generate a lot of cash. First and foremost, what we want to do with the cash is invest in the right spots in the business to continue, perpetuate the growth that we've continued to have. But after that, meaningful, accretive M&A is important to us, and we just closed on the two pieces, the La Nacional deal. What I say is meaningful and accretive is, we're also not going to overpay, which a year and a half ago was a lot easier to do. Now deals are more reasonable. So we're continually active on the M&A standpoint, but I kind of temper that expectation with, it's a contact sport. We're always looking at a lot of things. Are we particularly deep on anything? No, but we'll continue to look. But again, I think the meaningful, accretive, of a size that's digestible, of something where we have line of sight for synergies. La Nacional was a perfect example. I wish there were many more of those deals out there. But after M&A, after accretive M&A, we do have the buyback program, which was recently authorized by the board for an additional 100 million. With that, I'd say, are we planning our pace of buyback to change? Not necessarily. I think recent quarters, are a good depiction of that. But we wanted to give ourselves enough degrees of freedom with a large authorization by the board. That gives us some degrees of freedom, and the previous authorization was running out anyway, so it made sense to do a larger one, and also communicate to the market that we still, though our share price last year was up 53% in a down market, we still feel there's plenty of value in the stock.
Yep. Not too shabby. So question from the audience, and I think it's really more just a follow-up on mine. And you obviously, like I said, have a great buyback program, but at some point would you guys consider a dividend?
Yeah, I think we these things are a continuous discussion at the board level. Right now we think returning capital, we think the buyback makes the most sense right now. I think sometimes if you step into the dividend space, should you need that capital for something else, and if you back off the dividend, you get punished for that. It doesn't mean a dividend will never make sense for us or we'd never do it. Right now, at this moment, our preferred method of returning capital is through the buyback, which we think we've used pretty effectively.
Yeah. And then last question for me before I turn it back over to you for closing comments. But obviously the La Nacional deal was great for you guys. There'd be great if there were many more out there. But when you think about the M&A piece, are there more deals like that of that size, or are there larger transformative deals that could happen?
Yeah, I mean, I think never say never. I think we've looked at ones that if it made sense for the company are larger and more transformative. So I think that ones like La Nacional are perfect as a tuck-in acquisition. It worked within our existing credit facility. It was right in our wheelhouse. We saw a business that we could make much more efficient because we know exactly how to do it. But is transformative a possibility? Sure. And have we looked at things that are quite sizable and would require some different thinking to do? Sure. But I think that's part of I think at this size company growing at the pace we are, we have to always be open to multiple options on the acquiring front, and also have to be open to the options of being acquired. We're at the right thing for our shareholders. So yes, we cast a pretty wide net, but when we get down to writing the check, we're going to make sure it's studied and accretive, and it's going to work for the shareholders.
Great. We're getting toward the bottom of the hour. So Andras, appreciate the time. I'll turn it back over to you for any closing comments, and then we'll wrap it up.
Yeah, look, we thank everyone who's associated with this conference. We're happy to come and tell our growth story. I think it's we sit in a unique space. I think there's a little bit of a mindset out there that everything's gone to digital, and we believe we're gonna be there when more of our market goes to digital with a great product. But the retail space that we're in has tremendous runway. It's very profitable. In our humble opinion, nobody's doing it better than us. And last year we started to get recognized for that, which we're proud of. So at any rate, I'll wrap it up with that. Hope to hear and see others of you at other conferences or events.
All right, thanks, Andras. Thanks to the company time, and for everybody watching. Up next is Chico's at 10:30, and with that, we're out. Thanks.